Welcome all. I guess it's good to go. Thank you for joining us on today's webinar, that was on Saturday evening. So in this webinar, we are going to speak more about what is the 401k retirement account and what is the most important features and facts of the 401k account that we can utilize and make most of this investment revenue. So it's like as far as we all know, it's like mostly all the US NRIs or citizens use this specific tool, that is 401k retirement account, to build a good retirement corpus for their golden years. So hence, it's like there are a lot of features that we usually miss out on. So this webinar is specifically conducted because what we saw is a lot of our clients, US NRI clients, they all had 401k portfolio, but also they contributed in the same, but still they didn't have a better understanding about how the 401k portfolio works. So with this webinar, we try to bring you a better clarity about the 401k and more about the features of this 401k investment avenue. So let's start with some facts. So 63% of Americans are confused about the 401k retirement plans. So yeah, so in short, it's like a lot of people actually sign up for the employer-sponsored program and contribute in the same, but still they are very uncertain or not sure about what is the potential about this retirement account that we can have. So we'll start with basic and we'll start with step by step. So first would be, what is a 401k account actually? Yeah. So a 401k account is simply an employer-sponsored retirement savings plan where you actually can directly deduct money from your paycheck and put it towards your retirement age. So in this, it's like there are two main features that is called as traditional and Roth. So in traditional account, what happens is you will actually to suppose, for example, if you are in a higher tax bracket, to reduce a tax liability, you will actually maybe directly deduct from your salary, and without paying tax, you will actually defer it towards your retirement. But in Roth account, what happens is your post-tax dollars are being contributed towards the 401k account. So what happens in 401k is it's like you will have a set of allocation that is chosen by your employer, and you will be selecting across various internet investment alternatives ranging from mutual funds, direct stocks, bonds, etc. And that also depends upon the plan that is chosen by the employer. So this was one of the important investment avenue in US where people build a retirement corpus easily because it's well disciplined. Taking out money from the 401k account is very hard, and also the penalty is also very high. Hence, to get the discipline and everything, this would be one of the best and optimal way to contribute and make a good retirement corpus. So similarly, it's like before moving more forward, it's like you would have heard what similarly, it's like something called as a 403B plan and 457B plan. So yeah, so this 403B and 457B plan are also similar to that of 401k plans, but there is a difference. So 401k plan is actually open to all the employees that work at a private space, but whereas 403B plan is open for public school employees, colleges and universities, non-profit organization that qualify under 501c. Apart from that, the 457B, this specific plan is open and available to state and local governments and certain non-profit organizations. So actually, what are the main benefits of investing into a 401k plan? So tax planning. Suppose if you are a taxpayer, and if you fall under a higher tax slab rate in US, and hence you want to actually save some taxes and reduce your taxable liability. So what you will do is actually you will contribute to this 401k account, and the whatever contributions that you're making will actually claim it as deductions. So for that specific year. And hence this entire amount will grow at a tax deferred rate. And whenever during your retirement, you will just pay tax on that amount. So what usually happens is people starting now, maybe they would be in a higher slab rate, and the retirement time they would be in a lower slab rate. And hence it's like they would actually tune it out and have a lower and efficient tax liability. So apart from that, tax deferred growth. So it's like one thing is you are not paying any taxes on the whatever growth is that is happening in the portfolio, but during the retirement, you'll have to pay tax on that. Apart from that, there is also one more option. It would be after tax dollars. So in after tax dollars 401k, that is Roth 401k, what happens is you are paying and contributing through the 401k account, that would be with the after tax money, but you won't get any deductions. So suppose, for example, if I'm earning 120 rupees and I am paying it from my after tax dollars, that $120 are my after tax dollars. So in that case, what happens is in my retirement, whatever corpus that I'm building would be completely tax free. But in case, suppose for example, my total income would be around 150 and that 30 would be around about the tax liability. What I'll do is actually I'll contribute it before tax and hence let it go tax deferred. Apart from that, one thing that people are a bit unaware of would be employer match. We'll talk about more in detail about the employer match feature in our upcoming slides too. So this would be the ultimate 401k guide. So what is Roth versus traditional? What is the importance of getting matched? How can you max out your 401k contributions? What are the options to diversify and rebalance your 401k portfolio? So starting with the first one, Roth versus traditional accounts. So as I said, in traditional account, the contributions are made pre-tax. So it can be deducted directly from your income. This will actually help you reduce your taxable income during the year of contribution. So as I said, it's like whatever the contribution that you're making, you can actually claim it as tax deductions. And similarly, in India, as we have EPF and Provident Fund, whatever contributions up to 1.5 lakh I'm making into PPF, right? I'm able to claim it as a deduction under Section 80C. Similarly, under traditional 401k, whatever contributions I'm making up to certain extent, we can actually claim it as deduction. And yeah, tax would be payable upon the withdrawal. That would be retirement, of course. And what happens in Roth 401k would be contributions would be made post-tax. So apart from that, what happens is in this, there won't be any deductions. So whatever contributions I'm making that are post-tax, and hence this earnings will also be growing tax-free, and it would be compounding at a good rate and etc. And hence during the retirement, you don't have to pay any tax. So that would be one thing. So some of you might have some doubt on what would be a better plan for me. It's like, should I go for something like a traditional 401k or a Roth 401k? So actually, what I would say is mix of both is fine. And apart from that, it also actually depends upon the what tax liability or tax rate that you fall into. So suppose, for example, if you think you're actually paying higher taxes and etc., try to contribute and max out your 401k plan and actually claim it as a tax deduction. Apart from that, if you would like to build a good corpus under your 401k account, we'll come up with other options that are available that you can contribute and make a good lump sum money. So okay, moving on to the importance of getting the match. So there are two options that are available. That is something called as a partial Roth 401k matching and full Roth 401k matching. So what happens under partial Roth 401k matching is, to a certain extent, whatever contributions that you're making, the employer will decide a certain set of percentage and actually contribute till that. So in India, as for EPF account, we have around 12% of the basic salary, right? So similarly, every employer will have a certain set of percentage that they'll fix on a salary, and hence they will share the the contribution in that. Suppose if I'm contributing 100 rupees and $100, and the employer will say, okay, if you contribute $100, I'll actually match the contribution up to 20% and I'll contribute $20. So similarly, it's like you should be aware of whatever the match and the options that are available with your employer and try to make the most out of it. So similarly, what does a full Roth 401k matching means? So with something called as a dollar to dollar matching, or also called as a full match. So in this case, what happens is, if I am paying 12% of my basic salary for my 401k contributions, the employer will also try to match it and try to make it as a 12% of the entire basic salary. So what does a match mean? So match would be something, it's like apart from your current salary, the employer match that they are providing, it would be actually kind of a free money. So why would you actually like to miss out on this free money, right? So you would like to compound it at a better rate of return and also like build a good retirement corpus. So hence getting the employer match is very important, and making the most of it is actually recommended. So how you can get the employer match right now is, you can actually reach out to your finance department or HR, and you can see it's like what are the company policies and what are the rules to get the employer match. For certain companies, there are different rules, like there might be some vesting schedules. So they might say it's like, okay, now over a period of 4 years, employee is going to contribute for a certain extent, but that total contributions would be directly yours only if you complete 4 years. So every year, 25% of the contributions would be vested, and hence certain companies might have the vesting schedules too. So yeah, moving on to the important part. What are the contribution limits for 401k account? So earlier, when we did the webinar last time, exactly in 2023, so the approximate amount that a maximum employee can contribute was up to 22,500. Recently, it has been revised considering inflation and other factors. And right now, this year, the maximum contribution that the employee can do under a 401k account is $23,000. Apart from that, it's like if you're above 50 years of age, you can actually do a catch-up contribution up to $7,500. Apart from that, it's like you can see on the lower side. So what are the combined employer and employee annual contribution? So we spoke about the match, right? Getting the employee and employer match. So in that combined, you can contribute maximum to $69,000 per financial year, according to the 2024 revised status. Apart from that, if you're above 50 years of age, you can contribute max up to $76,500. So with this, it's like you will have a set of discipline that you will follow and will try to get the employer match too, and hence build a good retirement corpus for your retirement goal. That would be one thing. So yeah. So, okay, 34% of the small business offer the employee retirement plans, right? So nearly half of the US people employees are also working for a small business. So only 1/3 people, right? So what about the remaining 2/3? For remaining 2/3, where should they go and contribute if you're there? If suppose, for example, if your employer is also not sponsoring you or providing you a 401k plan. So these are the list of options that you can actually have and consider. So you can consider this as an alternative. There's something called as a Roth IRA, traditional individual retirement account, simplified employee pension IRA, health savings account, and normal investment account. So exactly, there's no rule that says it's like you have to contribute into your 401k account just for a retirement purpose, right? Apart from all this, you can also open an individual broker account and make use of it. What I would recommend is, suppose, for example, if you are investing into 401k with your employer, and if you think the investment allocation options are very minimal or limited, you can try to have a separate Roth individual retirement account or a traditional individual retirement account. Because the scope of allocation or options that are available would be much higher. So apart from that, also, you could actually try to make most of the contribution limit and make most of the tax saving part too. So, okay, how is your 401k constructed? So I would like to pass on the baton to Harshil, and Harshil will guide you on it's like how the 401k is constructed and what is the strategy is to be used to make most out of it.
Thank you, Vinayak. Thank you all for joining in. I know we are in different time zones, but I have to say good evening in India here. But Vinayak took us through most of the complicated stuff in your 401k and what you should actually look at, when you're saving money in the US. So how is your 401k really constructed? So you get a lot of options, right? You get, when you're investing in your for your retirement in your 401k, you will get a lot of options depending on who your broker is, depending on who your sponsor is. And that money goes into mutual funds, stocks, bonds, and cash reserve. Usually what happens is because you are getting the options, you're going to be choosing as to where you're going to invest in. And the most confusing part is how much of what you need to do in that particular idea, in that particular theme, or whether you should go more towards equity, whether you should go towards debt. With that, all of that is the confusing part of your 401k. Right. So if you can go on to the next slide. Yeah. So all of you are sort of basketed in three risk profiles, which is aggressive, moderate, and conservative. And what we've seen also with all the options available to you in your 401k, everything is basketed, right? If you're an aggressive investor, you get to choose that. Right? Nobody else is telling you that no, this doesn't suit you. You shouldn't be doing this. You are the one who's going out and choosing, irrespective of whether it suits you or it doesn't suit you. Right? You're the one going out and choosing more aggressive. You are the one who's going out and choosing moderate. You are the one who's going and choosing out conservative. Nobody actually handholds you in that process to tell you that, listen, this is not something that you're supposed to be doing. Right now, in this sort of a market, or in this sort of a phase when you're looking to save for 20, 30 years, what is the asset allocation that you actually need to go out and have, right? Depending on what your goal is, depending on uh, uh, your current needs, how much of what you should have in a particular asset class, right? That's where it becomes extremely confusing for you as a saver in the US, saying you don't know what to do. But because this option is available to you, you have to go out and start parking your money here, whether it is, and you don't know whether your money is actually going to make money for you going forward as well, right? So you are basketed in aggressive, moderate, and conservative, and you are taking that call of saying, no, I am an aggressive investor, so I'm going to go out and start doing this. So let's look at an example of a target dated fund. Now, this is a very good idea. This is a very, very good opportunity. Why? Because they take care of your asset allocation, right? They would say that, for so many years, you need to be sticking towards equity, and then gradually you will be moved, your money would move from equity to debt, and other asset classes also. So it's very, very simple. It's very diversified. It works for you because it's simple, because all the headache of you taking that decision of switching in and switching out, it's out of your hands, it's in their hands. And it's more like, I just need to put it in and then forget about it, which is a very, very good pro. These are actually very good investment makers for you to actually go out and look at, right? But the flip, it's not customized to your needs. That's the most important con, because it's not customized to how your life is, what your actual goals are, what's going to come up for you in the future, right? It's a template. It's not a usually such cases, when you're looking to save money, it's not a one size fit all. My shirt would not fit your shirt. I mean, my shirt size would not fit you, right? It's the same way as your investments. It's your identity, it's your personality that should reflect onto how you're saving. So the only problem with all of this targeted funds is that it's not customized to an individual investor. It's just a template. It's a great template, but it might not work for you, because everybody's needs are sort of different, right? Yes, though when you take that decision of retirement, asset allocation does come into play, having a long-term approach does come into play, but being dynamic is in your hands. Being dynamic should be a part of whatever allocation that you're making in any asset class. Being dynamic is very, very important, right? And these are investment avenues that don't allow you to be dynamic. The dynamism is in their hands, depending on where you are in the current market, depending on what global scenario looks like. It doesn't make sense. All the fund would do is make sure that as and when you reach a particular age, at that point you would be shifted to another asset class. Right? It's just a template, but it's a great template. Okay. And so if you look at the mutual fund universe, you will see growth, blue chip, core. Then you would see quality, core quality. You would see all of that, right? When you open your 401k, you would see income, equity, income growth. You would see everything, right? But majorly, right, they're blue chip. There are small and mid caps. You would have that option of doing index funds. Then a lot of money does go into emerging markets, right? Because you start off very early, you would have a significant allocation towards emerging markets. Now, you as an investor need to be very aware of what is defined as emerging, and where a majority of the money within the emerging space is going. Right now, it has more to do with China, and investors are pulling out money into China. So all the money that went in 20 years, 15 years back into the emerging space was going into avenues that are on China, that are on other, that is on the Taiwanese side. So they are all considered as emerging, and for 15 years, most of my money is going there. Though, given the current scenario, 15 years back doesn't look like anything would have been affected, but they are at somewhere at 2007 level. So an investor for 15 years has not made much money. Though it might not reflect onto your overall portfolio, but you need to be aware of what that particular product is, where the money is going in that particular product, because your money is ultimately going to be in that, and it's very important for you to know that, right? It's very important for you to know the risks. Then there are money market funds, there are tips funds. These are all on the debt side, right? Value funds and hybrid funds, they all go in hand with your blue chip growth sort of allocation. And index funds happen to be the easiest method, for any investor to invest in the US, right? So your 401k is actually doing that also, and you're paying them some sort of fees as well, right? So index fund is sort of a very, very low cost product, and most of US money is actually going into index funds only. That's the only way where that's why you're seeing the Nasdaq at where it is today, because there are a lot of savers and a lot of money is going to the same place over and over again. Yeah, this is what I was telling about. So 65% of all 401k plan assets are actually invested in the mutual fund space, right? And within the mutual fund space also, there's not a lot of diversity. 60% of that is actually going into equity mutual funds, which means that it's only going towards a specific part of the market, right? And because all of these equity mutual funds are more blue chip oriented, more index oriented, so your money is the money that you're saving is actually going into the same place, which is just the top 100 or the top 500, right? Usually they say S&P 500. Let's cut it down to top 100, and within top 100 there is a high level of concentration within the top 7. Now you know what are the top 7 that I'm talking about. So a lot of money is continuously going from your savings account without you knowing into the same place over and over again, right? There's no diversity of investments that actually happen, right? And because we are choosing these options of targeted funds, because we are choosing these options of blue chip, core blue chip, value, all of the money is going into the same place, right? And that is actually a big risk, right? We are getting more and more concentrated. A lot of performance that is coming in from the index also is coming in just from the top 7, right? The magnificent 7 is what they say. So a lot of concentration is coming there, and that's a risk that you are running as a saver, right? So your job is to ensure that your 401k is properly diversified, right? Not that I have 20 more years, yes, but you can play different cycles within that 20 years as well, right? And it's a good thing that when it comes under your control, you can take that decision for your own self, right? But a majority of the money is getting concentrated in the same place over and over again. Yeah. So average asset allocation of your 401k plan, again, if you look at it, 70% of it is on the equity side. There's not a lot of there is a good amount of targeted funds, but debt, very, very small. Debt in the US is still developing. So if you compare it to India, we are nothing. We are very, very small. We're very, very nascent. But debt itself in the US is sort of developing, and there are more and more equity products going forward. There are more and more ETFs. It's becoming more and more complex for a saver in the US to take advantage of the equity space there. It is getting more and more complicated because there are more and more products that are coming in, because it's getting more and more complex for even in savers in the US to sort of go out and understand what's really happening, right? If you can move on to the next slide. Yeah, like I said, because everybody's money is going to the same place, here valuations really come into place. It's very, very important for you to look at how your money is actually going to make money in the future. If you start off at a point that is not very favorable in terms of valuations. Now, this is not just in terms of all-time highs. Let me be clear. This has everything to do with the earnings trajectory of the company. This has everything to do with what you're actually paying for that growth. And the more you start paying a lot for that particular growth, you're foregoing the future growth that can come to you. Right. So we are in this place right now where valuations have skyrocketed. You're already seeing in the news about how this is a more technology-oriented rally, and still there are a lot of macro issues that are going on in the US, where valuations are not really justifying to what growth can come in from the entire of 500 companies that are there. Right. So right now we are topping. So which means as a saver in the States, the more money you start pumping into your 401k, the more money is going into equity, the more money is actually going towards expensive parts of the market. And that's why you're running the risk of foregoing your future growth that can come to you. Right? No matter how further that can be into your life, but you are actually going to forego future growth that can come to you. Sorry, I think it's stuck. But anyways, I think it's come now. Yeah. So the best way for you to understand rebalancing is it's very simple. There's nothing for you to time. There's nothing for you to get panicked about. There's nothing for you to track on a daily basis. It's just for you to become a lot more aware and build a simple habit of saving, which means it's just buy, right? And 401k has made it very, very easy for you to build that habit of saving regularly and saving more into it, right? Only then your compounding will work for you. So don't try to time it. Uh, Realign all your goals to your original investment plan and your financial goals, and you will do just fine. So save more and contribute more. That's what you need to think of when you think of rebalancing. Right. And now I would, I think Vinayak, you can just step in.
Yeah, okay. So thank you, Harshil, for giving a broad outlook about the strategy and more about the allocation of the 401k accounts. So it's like before investing in any investment product or investment avenue, it's very important to review your risk tolerance and risk capacity. So it's just one example. It's like recently one of my client had let me know. It's like they wanted to like compound the money very like at a higher rate at a lower tenure. So they wanted to be heavily invested into like small cap and mid cap space. So that won't be optimal scenario. The important thing would be you have to review your risk tolerance and risk capacity. Then based on your risk tenure and your investment tenure and your financial goal length and uh, whatever would be your financial goal and whatever your investment objective it is, it's like your investment decisions also should be based on that. It won't be rather than similarly just it's like if something is at a market high or something like that, we'll go and pump in a money too. So we have to do the careful evaluations and everything about the investment avenue before investing in, because there are plenty of mutual fund schemes or ETF schemes that are available in. So reach out to your investment advisor or financial advisor and do discuss with them and find out what is the best ETF or index fund or mutual fund that aligns to your financial goals, and that would be the case. So what do you do when you retire early or are you planning to make a shift? So actually job hopping is very common nowadays, but it can actually lead to confusion in managing your retirement accounts. Because it's like mostly if you have a 401k account with your previous employers, some of your new employers might not provide with an option to roll over to your new 401k plan. So hence in that case, what you can do is you can actually roll over your previous 401k account to a new IRA account. Because in your previous 401k account, if you don't roll over it, it's like you won't be able to contribute in it. You will be obviously able to change the allocation, etc. on this, but it's actually important to contribute in it, and hence shifting it or rolling it over to a new IRA account would be kind of beneficial. So it's also actually crucial to ensure that the rollover is done correctly to avoid any unwanted tax consequences too. So that would be one thing. So, okay, so how to consistently build and increase your 401k? So as we saw, it's like start your 401k from the earliest age you can. If you have joined the company, if you know it's like your employer is providing a 401k plan, try to participate in it, try to get a full employer match. Go speak to your HR and financial team and find out what are the company clauses and rules to participate in the employer match, and stay until you're vested. So as I said, it's like some companies might have a vesting schedule. So maybe 4 years or 5 years down the line to get the entire employer contributions that you have accumulated so far. So apart from that, it's like it's actually not that mandatory, but rebalancing your portfolio at least once a year is important, so that it's like you are actually you have a complete oversight on the portfolio, and also it's like, okay, based on my investment tenure, what my portfolio is doing so far. So that would be one thing. So don't just go for the default target dated funds. It sounds good and interesting, but maybe it won't be a good optimal product for all the investors. So make sure also you track for your 401k plans from your previous employers. Apart from that, it's like it's not an interesting thing to do, but actually try reading your quarterly statements or maybe reports or review your investments whenever you can. And also ask for help whenever you need it. There are a lot of investment advisors and financial advisors who will be happy to help you out in this journey. And also it's like what the study of Bloomberg had found out was, it's like when a 401k account was managed by an investment advisor, the discipline in that and the allocation was well balanced. So hence, that would be one thing. Apart from that, yeah, staying on top of your 401k company match. So here are three steps to take your employer match contribution to next level. One thing would be understand your company rules for contributions. It's like what are the certain set of percentages that you have to cross, then you'll get your employer's contribution to. Speak to HR, as I said, what is your employer sponsored plan? What are the investment locations that you can select in? Apart from that, also learn about your vesting schedule. That would be the main fact. So, okay, we'll just talk a little bit more about us also. It's like, who is ithought? So, ithought is a SEBI registered firm. We have deep roots in research and strategy. We specialize in managing investments, equity, fixed income, and multi-asset. Approximately right now, we closely manage around about 1,500 plus crores of financial assets, about 1,500 plus families. So our main job role is to manage wealth and create wealth for our clients and everything. So moving forward, more about the PMS part, I would like Harshil to speak on the same and also give a brief intro about the Spear as a payment product.
Yeah. So within the ithought PMS universe, we have 4 strategies. One is your multi-cap, which is your flexi-cap strategy. Then is your large cap strategy. Then is your small cap. And the other one is a multi-asset strategy. So the multi-asset strategy sort of works for all savers, whether you are in the US, whether you are wherever you are in any part of the world. Anybody looking to sort of build wealth in India, that's what happens. So what we can do is actually we can stop with this slide and then we can take over questions. So basically what we do is our investment philosophy is yes, we do think of long term. So even when we want to do your review for 401k, we will only look at it from a long term sort of an angle and whether things work out for you or not. Right? Whether it is in line with your risk profile, whether it is in line with your goals that are coming up. Right? So having a long term focus is very good. The way we sort of build our portfolios also is very non-consensus, which means we don't follow a particular herd. We do contrarian investments, which means what makes sense is what we would like to do. We only like to do a bottom-up approach where we want to stick to companies that are going strong, that are monopoly businesses, and usually they are within the top 2 in their respective field or respective industry. Right? So we only look to do such investments in those businesses. Usually you don't get those businesses at very fair to cheap sort of valuations, but when we do get them, we do build a significant chunk in those businesses. So that actually helps us. Right. So that is usually our style of what we and how we invest here in India. And India is an emerging market. India is the only country that is offering you 7% growth rate, and it's one of the fastest growing nations right now. And this is what we are doing in India because right now Indian market also are getting very heated, and we've always stayed very conscious in terms of valuation. So we are very conservative in terms of what we want to pay, but very aggressive in how we're building our positions in such monopoly businesses. And that's how we are looking to save, and that's how we are looking to build wealth here in India. So what we'll do is we'll open up the floor for Q&A. So whatever questions you had in terms of your 401k, in terms of investing in India, please put your questions in the chat box, and we'll be very happy to address it. Thank you. And with whatever question you have, you can just type it in the the chat box.
My 401k is concentrated only across 2 funds. So
to be honest, you're not the only one that is being concentrated on 2 funds. It's most of the savers in the US that are concentrated only on 2 or 3 index funds or funds that are there. You will get a lot of options, right? You will get a lot of options with your 401k saying that, listen, these are the options available to you, and you choose. Right? Even if it's the other way around, there will not be a lot of they will over diversify into equity, debt, REITs, some certain commodities you will get, small and mid cap, everything you will get. So even on your 401k, it's very extreme. You're either concentrated or you're very over diversified. So yes, we can review it. So I think you can just put in the number which is there on the next slide. So Vinayak will be able to help you out in terms of reviewing your 401k. Will India also go the indexing way? No, I do not think that India will go the indexing way. See, right now also in the entire, so I did a webinar on ETFs and basically your passive versus active investing. And what we found out was that there's a lot of money that's being concentrated only on, say, one particular or two particular indexes, right? That is on the equity side. Within the equity side, you are having more of the top 50. And second, you are having a lot of government-owned ETFs, that is government companies related ETFs, that because they are very liquid in nature, they get a lot of flows. Right? On the debt side, it's flip. It's completely government, right? Private debt in India is still very nascent. We are still in that space of the corporates actually have to go out and start borrowing money. Because right now, if you look at our banking system, it's one of the it is in one of the best places in history. Even during COVID, our banking system was not stressed out. We actually were getting recapitalized in the years before, and we got recapitalized even during COVID. Right? So private debt has still not picked up, which means that companies are not going to market to pick up debt. So everything is more linked to government. So whatever the ETFs and index funds that you're seeing is more government linked, government oriented. So I don't think that India is going to go the indexing way. It is a good option to as a complement to your existing active portfolio. Like say, for example, you are taking a sort of Nifty 250, which is a good mix of small and mid caps, right? A good mix of large, mid, and small, where you are having 60% on the large cap space, and then everything else is split up into the other segment. But because you will be sticking more to the benchmark, you will have some sort of benchmark linked returns. So you can use ETFs and index that are sector specific to complement that active portfolio on where the active portfolio is missing out. So that's what we do here. That's how we have created one of the PMS is called Neo, where it's a basket approach. Right, so we do have the option of taking ETFs, we do have the option of taking these index funds along with direct stocks. Let's say, for example, in that particular product right now, financialization is a big theme. Right, so we are having more banking oriented, we are having more financial services oriented companies which we're looking to build for the next 7-8 years. There we have the option to go via the mutual fund way, via the index way, which is so basically passive, active, and direct stocks. So we are taking a basket approach. So where the index is missing out, or where the active fund is missing out, there we're able to basket it by having specific stocks, specific ETFs that are more private banking or public sector oriented. So we are able to do that. And if you do want this sort of approach, with us, where you also want to take some basket approach here in India, or you want to do it in the US, we can definitely help you out with that. Right. So India, I don't think is going to go the indexing way. We still have a long way to go just in terms of active management. We had a lot of regulatory issues that came in 2017 regarding active management, but we are still very small in terms of indexing. Like as and more participation takes place in India, India is a very growing country. It's a lot of if you look at our pyramid, we still are heading into the lower income, just slightly going above. So we still have a long way to go. Can you explain more about rebalancing? Do I have to pay taxes on sold assets while rebalancing? Vinayak, if you want to take this question.
So actually, sir, while rebalancing, you won't have to be worried about any taxes. You won't have to pay any taxes during rebalance. So whatever the gains are there or all, so no capital gain tax on that. But suppose, for example, if it is via Roth 401k, if it is after your after-tax dollars, then you won't have to pay any tax for sure in the retirement when you withdraw it. But if it is a traditional 401k account, where is it from pre-taxed income? So in that case, whatever the taxation is there and whatever taxation part will there, it will be only triggered in during your retirement or during your withdrawal. So during your rebalancing, there won't be any taxation.
Sorry, and this is pertaining to the targeted date fund, right?
Actually, for all the schemes, so all the ETFs and mutual fund schemes, it is fine. So if you have a targeted funds, you can maybe if you want other allocation, you can just stop the contribution towards targeted funds and shift into other plans too.
In your opinion, is the Nifty 50 craze similar to over concentration now? No, I don't think so, because right now, if you compare where the returns of Nifty 50 is actually coming from, oh sorry, Nifty 500, a majority of small and mid caps have actually gotten a lot of money. So you can compare Nifty 50, Nifty small cap and Nifty mid cap craze to over concentration. Actually, we have a good slide. Vinayak, if you can just show the quilt.
Asset allocation quilt, right?
Yeah, the quilt. Just you can just present the quilt. It's much more easier. So the craze is only around small and mid caps. Investors in India are going a lot more gung-ho over small and mid caps because the liquidity is low. Naturally, the more money going in, the returns continue to follow, irrespective of whether the company is growing or not, irrespective of whether valuations overshoot growth. So within the market, small and mid caps are going through a bit of craze. So if you look at the chart, if you see from 14 onwards, small caps have continuously been outperforming. 14 to 18 was a very, very big bull market for small caps and mid caps. They got recognized very well in terms of the strength that they were showing also on the in earnings growth, and naturally valuations were reflecting on that growth. And after that, what happened was, because investors are more hindsight biased, be it in India, be it in the US, definitely that overhang of performance in small caps was high. So naturally, when you keep seeing money being printed and money getting pumped into the market, money is going into small caps and mid caps. Right? So there is a lot of concentration only happening on that. But if you look at India, gold has been a consistent performer since 2018. It's not only in India. Yeah, the dollar somehow has not, given the macro conditions now there, it has still remained, strong. But India has, the Indian rupee has appreciated against all the other currencies except for the dollar, and the dollar does have a lot of risk when it comes to interest rates and inflation. And the US debt levels are very, very high. They're somewhat on the crazy level, right? So if you compare that to gold, gold has done phenomenally well in India, right? So investors do have that overhang of craze in the small and mid cap space, but not more reflecting to that particular growth. Do you have an investment advice with US stocks? Not yet. See, we are reviewing your 401k, and we do have some sort of that expertise that we've built over the last 3-4 years in dealing with investors in the US. We have partnered with a lot of investors in the US who supported us over many years, and right now we are not doing a direct advice on US stocks. However, anything can. I'm leaving it very open-ended in the future. Right now, we are only sticking to reviewing your 401ks and seeing what is the best option for you to do as a saver in the US and how your money can actually work for you. Okay. But I'm leaving it very open-ended to what can happen in the future, because India is developing. India is making it easy for. They want to make it easy for money to flow from India out and out to India. Right, that's where the gift city comes in. Developments are taking place. They will take place also. So definitely, you would see us also participate when regulations do come in. They start to harden. They get set in stone. We would have, some bit of role to also play in when things shape up, when things get a lot more mature than what they are now. Whether you think there will be a significant difference in returns by shuffling the allocations based on market conditions, as many cannot time the market and adjust just to keep it simple. Allocate to a couple of funds like growth and index funds and let them grow 15 years. Do you see any problem? See, there's no problem with that approach. Now, the one problem that I have is you were thinking about significant difference in returns, right? What I'm talking about is more to do with preserving your returns, right? Equity is very volatile. You see, even in the top 7, right? Even in your index funds, last year the drawdowns were very bad. For a large cap, their drawdowns were very, very bad, right? You saw large companies like Meta and the entire semiconductor part go through a really bad phase, though they are cyclical, right? They are pretty large, right? So the only problem of what you should be thinking of is not making more money, but preserving what you have made. And that's why you need to shuffle your allocation, not because you can make more of it, but for some years, right, you have to preserve. You have no choice. Like, for example, if you look at in India, uh, so small and mid caps went through a really bad phase. 18, 19, 20 was just that 1 year was good. But if you see an investor investing on the 1st of Jan, 2nd or 3rd, whatever the first week or second week, deciding that I've seen really good returns, I'm going to go out and start doing completely equity, right? One, they've missed out on debt and they missed out on gold, because the point at which you start also is somewhere on the higher side, and it is negatively affecting you, right? So in lieu of making that extra difference in returns, you're missing out on what you've made in terms of how you should be saving it, right? So for an investor, safety is what you should be considering, right? Once you have sort of had a good a journey of compounding, how do you preserve it to make sure that you're consistently growing after that, right? That's how we see asset allocation, not in terms of, okay, this one is giving you further opportunity to take you and bump you up from here. No, we only see this as, yes, it's heated. Now we need to go towards assets that don't yield that much. It's okay for us to go a couple of years without getting any much yield, right? So we had taken a conscious call of shifting away from small and mid caps during the 14 to 17 cycle and heading more towards the larger caps and the gold side. Debt we were able to do only when a very bad opportunity opened up during a crisis here, when a AAA, the premium creamy layer of the entire debt market, when a AAA company defaulted because of interest rates issue, and we were able to take advantage of corporate bonds. So if you see here in 19, corporate bond comes up on the 10% side, right? And we were allocating more money towards safety on the gold side and on the large cap side, right? We got an opportunity on the debt side, we were able to take it on the debt side, right? So some years you need to think of capital preservation and need to look at asset classes that offer you that sort of preservation along with slight growth. You don't have to be too picky on the growth side, but you have to think of preserving it, and then you can make a shift back into equity as and when things get a lot more better, right? But right now, that's what you should be thinking of. So there is no problem in terms of how you look at a couple of growth funds and index funds and let them grow. But how you should be looking at asset allocation and shuffling your allocation is from a point of capital preservation. Yes, I think so. It's a good idea. If preserving money is more important, it's a good idea to move to treasury bills for now, as they offer good returns. Yes, and rebalance later when the P adjusts, and chopping and changing like this is advisable. Yeah, debt in the US is giving you an opportunity. I think a couple of weeks back there was a very good opportunity before the Fed meet, where you were getting good opportunities on the shorter term side. Right now, you're not getting opportunities on the shorter term side. You don't need to take a long term sort of approach. So it depends on your risk profile, depends on what you think, what your goal is. So what you can do is you can review your portfolio with us. We'll see whether we can accommodate some bit of debt in your portfolio based on what your goal is, based on what your profile is, and then see where do we actually need to go out and park money on the debt side. But just in terms of opportunity on the debt in the US, some opportunity opened up. Let's wait for the Fed meet. The language that keeps coming out from the Fed has always it has never been to the tune of the market, and now they want it to be to the tune of the market. So they're expecting rate cuts. We don't think that the possibility of a rate cut is very high, because inflation is still very strong. Your household inflation is still very high. A lot of cost has gone up. So let's see what happens. The expectation right now is that interest rates would come in. So let's see what happens. That's where the opportunity lies on the debt side. That's why debt becomes a lot more trickier than equity investments.
Sure, sir, I'll reach out to you via text on WhatsApp.
Done. So we have time for another 1 or 2 questions. But with whatever investments you're having in the US, with your 401ks, we have opened up and now we are reviewing it. So do get in touch with us. Vinayak, if you can just put the number so that you can get in touch with us, and then we can construct something for you. We can help you out in understand in helping you understand how you should be looking at your 401k and what's the sort of direction that you need to take with saving in the US. Second, when we are looking at opportunities on the India side, we can help you even on the India side when it comes to you parking money here in India. That again comes with you having a particular goal. Maybe you want to come back here. Maybe you want to give money here, or you just want to build from a wealth creation point in an emerging market. So we will be able to help you out with that also. So Vinayak, if you can just put the return slide also. They can see in terms of all our strategies as to how they've been performing. Yeah. So this is the multi-asset product that that can work for you, because it doesn't allow you to just stick to one asset class. There's no cap on a particular asset class. We can go from 0 to 100 in equity. We can go to 0 to 100 in gold. We can go 0 to 100 in silver, cash, debt, anything. And we don't have a cap on the category as well. We can have more stocks. We can have more ETFs. We can have more index also. But like I said, our index is not just going to be indexed because we are a sectoral and thematic driven house. We have been doing thematic investments since inception, and because we've built that expertise, since inception. Here we just want to take it up and layer it with our core ideas. So you will have a good complement of different categories within asset classes that can actually work for you. So we started formally as a PMS product on 16 December, and since inception, Neo has done about 28.5%. But our entire endeavor is that we are looking to build wealth for more than 10 years plus. We want to work with investors who have a 10-year plus horizon. 7 to 10 years is fine. This fund has no exit load. The fees of this fund is somewhere around 1.5%, which is charged. It's a yearly charge, but it will be billed to you quarterly. And our return expectation that we are setting is somewhere around 12 to 15%. So what you're seeing now is a good jump in the last 2 years since inception. But from a longer term perspective, we expect to normalize consistent growth at somewhere around 12 to 15%. That's how we built this model. So it's more than FD here that you're getting while you park from the US here in India. And it's much more than what the country itself is growing. So that's what we aim to grow at. So I don't think that there are any further questions. So thank you all for joining in. Have a great weekend ahead. Thank you for taking out the time to engage with us. Thank you.
Thank you.